What if one of the most respected tech analysts on Wall Street is right, and one AI stock today becomes critical infrastructure tomorrow? What if the recent pullback in CoreWeave isn't a warning sign, but actually, an entry point? And most importantly, should everyday investors follow Dan Ives into this trade? Wherever you're watching from, the United States, Europe, or anywhere else, welcome to the channel. If you want calm, research-driven market analysis, subscribe, and let's continue. Dan Ives isn't just another analyst. He was early on cloud, early on cybersecurity, early on enterprise AI. So when he reinstates CoreWeave into the Ives AI 30 list, markets pay attention. Ives believes 2026 will mark the acceleration phase of enterprise AI adoption, and CoreWeave sits directly in that data pipeline. But what exactly is CoreWeave, and why is sentiment still so divided? CoreWeave isn't a consumer brand, it's infrastructure. The company provides high-density GPU cloud computing for AI labs, enterprises, and hyperscalers. Model training, inference, large-scale deployments, and critically, CoreWeave is deeply tied to Nvidia's ecosystem. This isn't speculative AI software. This is compute, the backbone of AI. Over the last year, CRWV traded between $33 and $187. That kind of volatility does two things. It scares short-term investors, and it attracts long-term capital. Recently, the stock corrected, then rebounded more than 7% in just 5 days. That tells us something important. AI money hasn't left. It's becoming selective. In the third quarter of 2025, CoreWeave posted $1.36 billion in revenue. That's more than double year over year. Adjusted EBITDA? $838 million, a 61% margin. That's not hype, that's execution. And then there's backlog, $55.6 billion in contracted future revenue. Meta, OpenAI, a global hyperscaler. These aren't experimental contracts, they're long-term infrastructure commitments. But let's slow down for a moment. CoreWeave is capital-intensive. Debt to equity above 3.6 times. No GAAP profits yet. This is the classic AI infrastructure trade-off: build first, monetize later. If AI demand slows, balance sheets matter. And this is where investor psychology comes in. Belief must eventually meet cash flow. Analysts still rate CoreWeave a strong buy. Average price target, $131, roughly 70% upside. Bull case targets reach $200, but those targets depend on execution. Capacity scaling, debt control, sustained AI demand. This isn't a trade, it's a conviction investment. So, should you buy CoreWeave stock? If you're looking for dividends or near-term profits, this isn't it. But if you believe AI infrastructure will be as essential as cloud was a decade ago, then CoreWeave represents something rare, a pure-play AI infrastructure company already generating billions in revenue. The opportunity is real, the risk is real, and the next 18 months will decide which side wins. So here's the real question. Is CoreWeave the backbone of AI's future, or just another expensive build-out ahead of demand? Let me know your view in the comments. Subscribe for more long-form market analysis. Thanks for watching.